Welcome back, everyone, to Vox Markets. My name is Paul Hill, and on today's edition of Voice of Wall Street, I am delighted to be able to speak to Dan Ives, Managing Director at Wedbush Securities, an expert in all things technology and software related. So welcome, Dan.
Yeah, great to be here.
Yeah, well, given all the recent angst on about inflation and rising bond yields, what's your sort of view for software and technology going forward?
Look, I think it's been a gift, any sort of sell-off on a 20-bit move in the 10-year. It's my view that we're in the midst of a multi-year bull rally for tech stocks. We think, NASDAQ 20,000 is something we'll see in the next 12 to 18 months. So in our opinion, it's the fourth industrial revolution that's shaping up across tech, cloud, cybersecurity, electric vehicles. We're just not ones, never have been my 20 plus years covering the tech stocks in the street, where I become maniacally focused on on the 10-year and inflation. I think many that have kind of done that rotation trade, I think they've been really caught I think in a conundrum here.
So how do you actually go about picking the winners? Because that's the really tough part. You've got so many tech stocks you can choose from. In fact, we've really had sort of a deluge in the IPO market and through sort of like SPACs as well. And it's really sort of for investors. How do you go about sort of like looking for the ones which are going to do well as stocks rather than sort of like, ones which are sort of just very, very well, sort of like bid up?
Yeah, look, I think it becomes really a stock picker's market. I think you got to focus on the names that it starts off with the technology competitive moat. A good example, like in cybersecurity, like Zscaler from the beginning, like I looked at that as a company, like massive technology moat. It was just a matter of the stock catching up to it. And obviously we've seen the results of that. I think other examples are sometimes seeing forest through trees, where I think there's disconnects in stock. We saw that in names like Docusign is a good example, kind of pre-pandemic. And it's really, I think it's also focusing on some subsectors. Like to me, like it's a golden age for cloud, cybersecurity, and really electric vehicles. You'll have some losers in those, in those sectors, but overall, I think these are names over the next 2 years. A lot of these stocks are probably doubles.
Yeah, and it's certainly, I would agree with regards to everything's being digitized, everything's been sort of like cloudified, and it's just improving the sort of like definitely the quality of life. Now, you just touched on electric vehicles, and obviously we've got the poster child, which has been called Tesla, which has been right in the sort of like the front and center of people's attention with the iconic leader Elon Musk. What's your view on Tesla? Because it's actually surprisingly, I was looking at the valuation. We've just got obviously over $1 trillion, but in compared to sort of like Techland, actually it's not all that expensive.
Well, no, that's always been my view the last decade of Tesla. I've never treated it as an automotive company.
Yeah.
I've always treated it as a disruptive technology player. And I view it, this is a name that's going to a 2 trillion market cap. So I view it like EVs is the biggest transformation of auto industry since 1950s. I think it's a $5 trillion market over the next decade. And I think what's starting to happen now is just that adoption curve is ramping up more and more, which is why we continue to be super bullish on Tesla. But with Musk, always comes the sideshow, Twitter poll, Bitcoin, whatever it may be. And I think it's just, you always have to see on this name, like, where is the adoption going? Look at what's happening in terms of China. That's why, to me, this has really been just another sort of chapter in the book in terms of this Twitter poll, in terms of everything we've seen over the last week.
He's absolutely a terrific leader and marketeer. There's no doubt about it for that. But just sort of like, if you'd mentioned that it was the market size potentially in 10 years could be $5 trillion, what sort of market share would you expect somebody like Tesla? Just to give you a data point, in England here, most people only go for Tesla. They've only heard of Tesla, and they only go for Tesla cars. They're sold out everywhere, but other electric vehicles are sort of like still in the parking lot.
One also think about right now, if you're getting a car to England, where's that car being manufactured? It's being manufactured in China, shipped to England. Just wait till Giga Berlin gets up, and that's really going to be the artery throughout Europe that I think is going to incrementally gain share for Tesla. But look, I mean, my view of EVs globally, it's 3% of automotive today. So 3 million vehicles of 100 million that are out there are EVs. I think that's going to 30 or 40 million, over the next few, call it next 4 to 5 years. We think 10% adoption by 25, 25% by 2030. I think one of the misperceptions is the zero-sum game. In China, NIO, XPeng, in Europe, we've seen obviously VW and a lot of others, Porsche, going after EVs, in the US, Ford, GM, many winners. So even though today 85% share that Tesla has, that goes down to 60% over time, with vehicles going from 3 million to 30 to 40 million. I mean, that basically means Tesla, a company that's producing 900,000 vehicles, say deliveries, they'll be doing 4 to 5 million annually.
Wow.
So it's my view from a valuation in 21 years of covering tech. If you focus too much on near-term PE and traditional fundamental DCF, you missed Amazon, you missed Netflix, you missed Tesla.
I missed all of them.
No, but I'm just saying it's my view. I'm not saying it's right, but it's my view that with transformative growth names, I think sometimes it's easy to lose sight of it when you start to view it on traditional valuation metrics 1 2 years out.
I think you're totally right. Certainly when it comes to sort of, you look at the movie, and it's what's really interesting, which is another stock you like as well. But essentially, if you could almost say, well, Tesla with its ecosystem around software, data, autonomous vehicles, plus the hardware, is actually not that dissimilar sort of 10 years earlier for Apple in terms of the iPhone, because we're looking at the
couldn't
same,
agree more.
Are we looking at the same sort of like system and economies of scale and barriers to entry? Is it going to be a similar movie? And I mean, we know how successful the iPhone's been.
No, that's exactly. It's about the ecosystem. It's about the software services, and I think it's another example like Apple. You go back to many of the haters. I mean, look, my Shih Tzu and Terrier could have picked Apple 6 or 7 years ago. You buy it at 12 times earnings, you sell it at 16 times PE. That was the way you trade Apple. But it's different now because of the re-rating on services. We think services, Street was assigning a valuation of $200 billion 2 to 3 years ago. Today, that valuation, in our opinion, is 1.4 to 1.5 trillion. It's been a re-rating on services for Apple. And that's why I think there's going to be a $3 trillion market cap going into next year. Yeah,
well, Warren Buffett is also on your page, isn't he? Because that's quite interesting. You can be a value and GARP investor and go into sort of like big tech.
Because you got to do some of the part. I think Apple, you have to view it some of the parts.
Yeah.
And then if you view on traditional PE, I think in my opinion,
actually, I mean, I was just looking, actually, Apple is actually not that expensive, is it? It's on about sort of 25, 26 times next year's PE. So, for a growing business, that's probably not too bad. Now, just moving on to sort of into another area of the, of not so much the EV space, but potentially ride hailing. And what's your view on sort of Uber and Lyft? Because these guys have got unbelievable brands. I mean, we all know it's a verb in the American lexicon, never mind the English dictionary. And it's all, but they're using the brand extension to go into obviously food delivery, and then ultimately, I guess, will be autonomous vehicles. What's your view on those guys? Because they haven't really yet started. Well, Uber hasn't started making profits, but it's within their sort of like grasp at the moment.
Look, they've been, I mean, let's call it like it is. Like since the IPO, these have been like Everest-like uphill battles as stocks.
Yeah,
because you had the profitability issue. Then, of course, pandemic. I mean, Uber's had the food delivery. But if you look at that, I mean, at one point, rideshare was down 90%. So it's taken time, but I think now we're starting to see light at the end of the tunnel. I mean, you start to see profits. I think the whole worker employee issue, contractor, it's noisy, as you know, especially in England, but I think it's gotten smoothed out relative to the business model. I think these are rebound plays. I mean, I think they're re-rating stories. A lot of the regulatory stuff's cleared. And the big thing for Uber is going to be like, you'll have a moderation of food delivery, but now you're going to have a spike in ride sharing. For Lyft, a lot of it's going to be about autonomous. I mean, that's a big focus for them going forward.
I did see, actually, there was some investigation at some of these major sort of like international cities in terms of stopping all cars other than sort of autonomous vehicles. And if they do it in the centres to improve the air quality, and again, that will play perfectly to ultimately to the likes of Lyft and Uber, I guess, or even Tesla.
No, exactly. Look, I mean, full self-driving and autonomous, whether it's 2025, 2026, I mean, it's not a matter, it's kind of like EVs. It's not a matter of if, it's going to go there at some form. And that's why there's a big question about like who wins, the regulatory to get through it. But that's good. Look, Uber, I think that Uber Hertz Tesla deal is the start of almost a robo-taxi framework where eventually it's going to head down over the coming years.
Yeah. And when you're getting this sort of like, this technology sort of transformation, digitalization, and also then, with AI and all kinds of things happening in acceleration of that innovation cycle. What's your view on sort of like Facebook sort of turning now to Meta platform? Because that's really quite interesting, because if you look at sort of what happened in social media originally, obviously Facebook sort of like replaced, I can't remember what it was, some big social network that I remember Fox News had, or News Corp had a long time ago. And now effectively Facebook is saying it's turning its back on its classic sort of like, social media site and moving into the meta universe. What's your view? How successful will that transformation be?
Well, also, I think Brussels and the Beltway, given their poster child of regulatory focus is Facebook. I think a lot of them changing the name is from a PR perspective. I mean, look, the reality is the next 5 to 7 years, it's social. I mean, we could call it Meta, Dan, Jim, Jane. Facebook continues to be social, and that's the monetization, right? Like in terms of the story. I think it was a smart move from a PR perspective. And in Metaverse, look, Metaverse is going to be an arms race, because next year I think Apple releases Apple Glass, which is the VR AR headset. And then it really is going to be the technology players going after Metaverse. Facebook is, invested billions there, but the monetization story is still probably 5-6 years away. And I think it's more Apple and Google that potentially have maybe an edge on Metaverse versus Facebook.
Right. There was a company which was listed recently. Is it Roadblock, was it, or something like that? Which is effectively using more than advertising, but it's essentially got that meta universe already set up, and people then have sort of like they buy and sell goods on there, isn't it? It's a different sort of platform, I guess.
Well, I think there's going to be a lot of Metaverse plays, in gaming, social media. There's names like Matterport that are potentially, meta play. So there's going to be a lot of meta plays. But to your earlier point, I think Metaverse, it's going to get noisy and crowded. And as an investor, deciphering who are the winners and losers, I think that's much more of a fork in the road.
Yeah.
In terms of names that could benefit. As opposed to like an EV green tidal wave, a lot of these names are going to benefit just because there's such a transformation going on. Cloud, cybersecurity, Metaverse. I think it's going to be a little trickier in terms of figuring out the winners.
And how do you actually, just with say cybersecurity, which is one of your favourite plays or favourite areas, hunting grounds, how do you go about selecting the winners there? Because you've got people like obviously FireEye, which forever has been cheap and not done much. You've got Checkpoint, which
and cheap for a reason, right?
Yeah, exactly.
It's kind of like when there's a pizza place and it says $1 pizza. Whoa, cheap. but maybe I end up at the hospital after I eat that slice. So cheap is not necessarily good, right?
Yeah. So what do you said Zscaler? What about people other sort of poster charts? You've got sort of you've got Palo Alto, even I mean people like CrowdStrike, but they're a bit expensive, I think. But you know, what?
Look, cybersecurity is another example of like the the next gen companies that are leading. CrowdStrike, Zscaler, you're going to have to pay out for those multiples. But I still think those are stocks that could go up another 40, 50% from here because of what's happened with cloud and because of the levels of threat going after companies and governments. And a lot of the work, we've covered cyber, since late 90s. And I view it as kind of like it's trying to focus on the companies that are leading the sort of next gen technology. I think Palo is a huge re-rating story and process. They've done a great job in terms of everything there. Especially shifting to the cloud. Then there's names like CyberArk, Tenable, SailPoint. They focus on sweet spots, identity, vulnerability management, some other areas where, we're talking to customers every day and trying to understand what's happening in the channel to see where the growth's going. I think cybersecurity, this is going to really be a subsector of tech that's going to be an outperformer.
And how big could cybersecurity get? I mean, I don't know how big it is at the moment, but I'm guessing it's probably a couple of $100 billion, I guess, per annum. Maybe
yeah, but it's only 5% of budgets today. I mean, It's only 5% of budgets. We know it goes 10% of budgets over the next few years. And we've used cyber, we peg it at a $1.2 trillion market over the next 6 years.
Right. And what about sort of like with the sort of the big sort of US giants, the tech giants and software, how will they be impacted either positively or negative by the crackdown in China in terms of, all things technology related, and also the risk from, sort of cyber warfare from people like China and Russia and stuff?
Yeah, US-China Cold Tech War is a clear, focus, in terms of what we're seeing in tech. But I think, look, outside Apple, which is all the production in China, 20% of demand, and Cook and Apple have been almost Teflon-like in terms of little disruption, supply, demand in China. But U.S. tech, I almost view what's happened with the crackdown from Big Brother in Beijing. It's bullish for U.S. tech.
Yeah.
More money. Right now, I mean, unless you like jumping off a cliff without a parachute, it's hard to own China tech, in terms of, Baidu and JD and, Tencent and others. I think more and more you're seeing money rotate to big US tech, which really have minimal play in China. I mean, even Microsoft folded what they were doing in LinkedIn. So I feel it is bullish in terms of just, even a power struggle going on. And also in that crackdown scale and scope's almost been bullish for U.S. tech, just given its clipped the wings of some of the Chinese giants.
Yeah, many governments, I think, are just banning, aren't they, to the Chinese software? I mean, certainly here in the UK, we've stripped out all of Huawei telco networking from the 5G platform, which is being implemented. I think that's been sort of like replicated around the world, hasn't it? And in many areas, things, lots of those companies are sort of struggling as well. So just moving on then, you talked about sort of buying the dip and looking for sort of opportunities. What about the likes of sort of the fintech plays and PayPal in particular? Because I saw that came out with some pretty sort of like lackluster earnings numbers a couple of days ago. And I did notice some pretty good sort of, value GARP investors saying this could be a buy the dip opportunity to get a premium name at a cheap price.
Yeah, I'd rather own Square.
Okay. Why is that? Why do you prefer Square to PayPal?
Well, I mean, to me, look, PayPal, especially ever since the eBay rumor, I think that's kind of soured investors. Anytime a company's potentially looking at a deal potentially falls apart. You show those lackluster numbers for PayPal. I think PayPal is a great value play, GARP in finance. But I think if I look at Square and everything they're doing in terms of their next gen initiatives, it's what I view as one of the more growthier tech plays in fintech. And we also like Coinbase in terms of playing crypto. That's another sort of name that we like.
And why do you, just before we move on from Square, what are their sort of next generation products they're bringing forward? What are those ones? What was sort of really catching your eye in there?
I mean, to me, it's really about mobility. I mean, I think if you look at the mobile wallet share, Square, I think, is disproportionately poised to benefit. And I think it's something where it's all going toward mobility, less cash in wallets, who's going to be the winners. PayPal's done a good job, but ultimately, I think Square continues to have the edge there.
Right, gotcha. Okay, and then sort of like just in terms of any areas you should be avoiding at all in technology, you would sort of like be underweight, or is it really sort of like spread your wings in different hotspots?
Yeah, I think social media right now is tough, just given the Apple iOS. Names like Snap, I think, are tough to own. Twitter, just given what we're seeing from the Apple iOS updates, there's a lot of excuses going on, dog ate the homework type stuff. I think realistically, it's Apple iOS, and they hold the keys to the kingdom.
And that's the cookie tracking ban.
Of course. I mean, and that's had a major impact. I mean, you've even seen retail, it's had impact across the board. But I really want to focus on cloud, cybersecurity. Microsoft's our favorite cloud name, as well as just, some of these larger tech plays going into next year. Look, we're going to have these exogenous events, 10-year inflation, different macro stuff, virus scares, everything else. But to me, it's a green light to own tech here.
Yeah, and with Microsoft, in that sort of like such a giant in the B2B space, you prefer the B2B, do you, to the sort of the more the B2C traditional plays?
Yeah, for me, and especially Microsoft, what's happened there, that's a massive transformation in terms of cloud re-rating and Redmond. And we think that's a $400 plus stock at the end of next year.
Brilliant. Okay, well, thanks very much, Dan, for your time. Terrific
Thanks for having me.
And no, great. And look forward in touching base again going forward.
Thank you.
Thank you.